In this video, we will be discussing the concept of cost of capital. So, according to I.M. Pandey, the cost of capital is the minimum acceptable rate of return on funds committed to the project. So, whatever we are fund investing into the project, the minimum acceptable rate of return is the cost of capital. So, the minimum acceptable rate or the required rate of return is a compensation for time and risk in the use of capital by the project. Ijra Solomon has defined the cost of capital is the minimum required rate of earning or the cutoff rate for capital expenditure, while Halley and Sell defined it as in a general sense the cost of capital is any discount rate used to value cash streams. So the rate at which we discount our cash flows is the cost of capital. We can see here there are mainly six and two more eight type of concept of cost of capital. First, the historical cost. So in very simple words, it is the cost of capital raised in the past. The future cost, the cost of capital that to be raised in the future. The specific cost. So the cost of specific source of capital is known as specific cost. Then the combined cost is the total amount of cost of capital obtained from different sources of finance is called combined cost. With respect to average cost of capital, it simply means weighted average cost of various sources of capital, the weight assigned to different sources of capital according to their proportion in the total capital, and the WACC is calculated. Then the marginal cost of capital, it is the average cost of additional funds raised for a new investment scheme. Then there are two concepts, implicit cost and the explicit cost. So implicit cost refers to the rate of return associated with the best alternative investment proposal that put aside if a management consider any other plan. It may be defined as the rate of return associated with the best investment opportunity for the firm and its shareholders that will be foregone if the project under consideration by the firm is accepted. Explicit cost of capital can be said as the discount rate that equates the present value of cash inflow and the present value of the cash outflow. The explicit cost of a particular source may be defined in terms of interest or dividend that the firm has to pay to the suppliers of the funds. So the cost of retained earning is the implicit cost, and the cost of equity, debt, and preference are explicit cost.